The Fed holding interest rates steady in a range of 3.5% to 3.25%. That was as expected. The latest so-called dot plot of Fed members' rate projections indicating that the central bank could cut rates once this year and once next year by 25 basis points each time. Officials see a slightly faster pace of GDP growth this year than they previously did, but they also see higher inflation. Growth in 2027 projected at 2.3%. That's higher than the previous 2% forecast. Fed Chair Jay Powell saying that it's too soon to know how the war in Iran will impact the U.S. economy. On the question of his future at the Fed and the criminal investigation initiated by the Trump administration, here's what Chairman Powell had to say.
I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
Powell saying that if his successor is not confirmed by the end of his term, he would serve as chair pro tem until someone is confirmed.
And joining us now, Kelsey Berro, fixed income portfolio manager at JPMorgan Asset Management. And I had my own thoughts on this, and after looking at your thoughts, Kelsey, they're very similar. I would say both sides of the mandate are more difficult at this point. If Powell says we've seen basically no private sector job growth and inflation risks are elevated, that's like adds to concern about both. But when it all comes down, you distill it all together, you still think the next move is not a hike or even staying pat. Sooner or later, there will be cuts in the offing.
Right.
Still.
Yeah, that is our view. So right now we're facing what is likely to be the largest energy shock on record going back to the 70s and 80s. And Chair Powell himself said you can basically throw out our forecasts. I would throw out their forecasts. But what am I focused on is the balance of risks to those forecasts. And 16 out of 19 participants saw upside risk to their inflation forecasts. That's kind of a given. We know this. Energy is already going up. But 16 out of 19 also see significant upside risk to unemployment. So the labor market is at risk here. And so that is the situation that the Fed is facing right now. And when you look at the movements in yields have been moving higher. And it's really been a function of this first order impact that the markets have been focused on. Yields higher because energy is higher. Inflation break-evens in the front end of the curve are moving higher. And what the market hasn't really started to calculate is those second round impacts associated with growth. If I look back at last year, we also had a supply shock. Very different supply shock, but it was tariffs. In that situation, the Fed stayed on hold, but ultimately the weaker labor market was what won out, and the Fed cut rates further.
In this situation we're in right now, it could both be inflationary and it could impact growth, and that you think the risk is actually weighed to that side. You point out that the 2-year inflation swaps have gone up, but still way below where they were like a couple of years ago. Was that with Ukraine? They got to 5%, so we went from 2.3 to 2.9. So still not hair on fire panic yet on this.
Right. So starting point is so important. Where were we when this energy shock started? And how does that compare to the last significant energy shock, which was 2022 when Russia invaded Ukraine? Now, you already highlighted the starting point for inflation is significantly lower today. So back in 2022, even before the invasion happened, inflation was already at 7%. Nominal GDP was at double digits, and the real policy rate was significantly negative. So we know why the Fed was hiking in 2022. Now you move forward to today. CPI is around 2.5%. Nominal GDP is around 5%. The real policy rate isn't as high as it used to be, but it's still modestly restrictive. And also fiscal policy is much less restrictive. And so I don't think that we should be responding to this the same way that we were responding to inflation risks back then.
Sure. So that's an argument for not hiking rates. But if you look at the argument against cutting rates, I mean, I think that's pretty clear, too. We're nowhere near 2%. We thought by this point, and we've been nowhere near 2% for so long at this point. It doesn't look like we'd even get there at the end of next year. That's a concerning cause. Do we just throw 2% out the window and say, okay, it's 3% potentially on the way to 4%?
Yeah, I don't think they can throw 2% out the window and not at least officially.
But they're more worried about jobs.
They are worried about jobs. And also, I think you mentioned the inflation swap market. We're watching that very closely, but not just the front end. We're looking at what does the market expect for inflation longer term. Yeah. And
Still
that
anchored,
has been
right?
very benign. I mean,
Still anchored.
The 10-year Treasury yield is right around 4.25. That's essentially the same spot that we were at before all of this started. Right. And that's a signal in and of itself.
Is it a signal of inflation expectations, or is it a signal of growth expectations, too?
I think it's a combination of two things. It's a signal of the fact that markets do think ultimately this is going to be somewhat short-lived. But secondarily, it could be an indication that even if this isn't short-lived, the near-term impact is higher inflation. The medium-term impact is weaker growth.
All in all, then, that's what I said. It's definitely a lot has changed since that Friday night. But at this point, it sounds like this is going to be another one of those situations where for financial markets in the economy, you don't want to overreact to what we see in the news every day. I mean, if you just read the news, it seems almost impossible that this backdrop isn't going to hurt everything, the market, and it has.
And yet the market's been pretty calm overall.
It has been. We're headed getting to 10%, aren't we, for a correction?
We were down 4% from the high for the S&P 500.
That's it.
2 days ago.
I agree. I don't think you want to overreact. Ultimately, you want to focus on those fundamentals and those valuations.
So many other things to overreact to, though, if in terms of the valuation and AI and all the other things.